Welcome to our lecture series in financial technical analysis. Today, we will talk about what technical analysis is all about. Let's begin. Technical analysis is the study of market behavior through charts, patterns, and mathematical indicators aiming to understand supply, demand, investor sentiment, and crowd behavior. It assumes all relevant information is reflected in prices and that prices move in identifiable and exploitable trends. Technical analysis originated from Charles Dow's work in the late 19th century, forming the foundation for modern practices. Its philosophy rests on three core principles: market action discounts everything, prices move in trends, and history tends to repeat itself. Technical analysis intersects with behavioral finance, as both disciplines focus on human psychology and decision-making. The concept of the self-fulfilling prophecy plays a crucial role, where collective trader behavior can make patterns come true. Moving averages smooth price data to identify trend direction, with simple moving average and exponential moving average being common forms. Traders use short-term MAs for timing entries and exits, while long-term MAs define the overall market trend. A golden cross, where a short-term MA crosses above a long-term MA, is a bullish signal. The opposite, a death cross, is bearish. Bollinger Bands consist of a moving average with two bands plotted above and below it, representing standard deviations of price volatility. When prices touch the upper band, the asset is considered overbought. Touching the lower band implies oversold conditions. Narrow bands suggest low volatility and potential breakouts, while wide bands indicate high volatility. Fibonacci retracement is based on the idea that markets often retrace predictable portions of prior moves before continuing. Traders use these levels to anticipate potential support or resistance zones, as prices often pause or reverse near them. The moving average. Convergence divergence, or MACD, measures the relationship between two moving averages. A bullish signal occurs when MACD crosses above its signal line, a bearish signal when it crosses below. Divergences between price and MACD can indicate weakening momentum or trend reversals. The Relative Strength Index, or RSI, measures the speed and magnitude of recent price changes to identify overbought or oversold conditions. RSI above 70 typically signals overbought conditions, while below 30 signals oversold conditions. Divergences between RSI and price trends often warn of possible reversals. Technical analysis is often criticized as being a self-fulfilling prophecy because collective behavior can drive prices predictably. This highlights that price movement reflects trader psychology, supported by behavioral finance concepts like herding and cognitive biases. Strengths include providing clear entry and exit signals, reflecting real market behavior, and applicability across asset classes. Weaknesses include reliance on historical data, potential for false signals, and the need for discipline to avoid emotional trading. Understanding these aspects allows for a more informed and balanced approach to financial market analysis. Thank you for watching our lecture on financial technical analysis, focusing on its definition. See you at the next lecture.